Good morning, good afternoon, good evening, everyone, and welcome to Ask the CFO and Key Performance Metrics. My name is Michelle Eisenberg, and I am a program assistant here at the NASDAQ Entrepreneurial Center. And for those of you who may not know, the NASDAQ Center is a nonprofit building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. So as you will see in the chat in a moment, the NASDAQ Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So definitely make sure to check out those links and resources in the chat. And then just a couple of housekeeping items before we get started. First, let us know where you are dialing in from in the chat. We always love to connect. And second, we are going to be taking live Q&A throughout the presentation and the event. So please make sure to submit your questions for us in that Q&A function at the bottom of your screen throughout the presentation, and we will try our best to get to as many as possible. And of course, none of what we do could be possible at the center without all of the amazing support from our sponsors, including NASDAQ, Lehigh University, BMO, Airbnb, KPMG, Wilson Sonsini, Microsoft Entrepreneurship for Positive Impact, BPM, and HubSpot for Startups. We are humbled by their contributions and hope you are grateful too. Awesome. So before we get started, we always like to launch just a couple polls to step back, see how everyone here is doing today. This first one is going to ask, how are you feeling? Fearful, anxious, surviving, or optimistic? And we'll give it just a couple moments for people to submit a response here. Thank you. Thank you. Awesome. All right, gonna go ahead and end this poll, share these results. Awesome. Looks like optimism in the lead, but definitely have some feelings of surviving in the audience. I'm very confident that our conversation today might help address some of those feelings. So I'm gonna stop sharing this poll and launch that second poll, which is gonna ask, what is keeping you up at night? Finance, sales, marketing, scale, pivot, team, or surviving? And this one just helps us understand your current needs as an entrepreneur so we can make sure we are continuing to provide meaningful programs and resources to all of you. So give that just another moment or two. Awesome. We got folks from Canada, Georgia, DC, California, Missouri, Illinois, Georgia. Welcome, welcome. So great to have you all here with us today. All right, gonna end this poll and share these results. Awesome. Finance coming up in the lead. Very fitting for our conversation today. But looks like we got needs all across the board here. So thank you all so much for participating. Super helpful. Gonna stop sharing that poll. And without any further delay, please join me in giving a warm welcome to our first special guest, Ronald Millsap, Director of US Zero Barriers to Business at BMO. Ronald, always a pleasure to have you here with us, and I'm going to pass it over to you.
Michelle, I echo the same sentiment. I was answering some of those questions. I always get a little nervous before any presentation, and what's keeping me up at night is just this economy and some of the headwinds that our small businesses are facing. It's just a pleasure to be here. Once again, I lead BMO's Zero Barriers to Business strategy. Our purpose is to boldly grow the good in business and in life. And that purpose comes to life really when we help our customers achieve real financial progress. We do that through this program by enabling capital access for women, Black, Hispanic, Latino, and Native American small businesses with better access to capital, educational resources, and meaningful networking opportunities. And this is just one of those many platforms and partnerships that we have to bring education, resources, and networking opportunities for our many businesses across our footprint, as well as our friends at the NASDAQ Center and all of the folks that you have as a part of your organization and membership that follow along here. So it's always a pleasure just to be in a great audience and crowd like this, sharing information about what we're doing at BMO, along with partners like Arena. So with that, I want to introduce my partners here for this call today, Heather Towson and Adam Baker. And I'll give you just a little bit about their backgrounds. BMO has been proud to be in partnership with Arena for at least a couple of years now, through our 1871 Women FedTech partnership and the work that we've been doing over the last year, bringing education to different diverse audiences. Arena and their story is just a marvelous story, led by a CEO and Heather Towson, bringing fractional CFO services to small businesses across the U.S. with more than 20 years in banking. She set out to start her own company and build this fractional business. She's not only that CFO, prior banker, but just deeply engaged in lots of community efforts. I see across different social media platforms doing education and supporting clients in their growth. And I also want to introduce Adam Baker, who is a fractional CFO that works for Arena with over 10 years of professional experience. Adam has partnered with multiple small and medium businesses, helping them grow in a variety of ways, from startups, SaaS firms, retail shops, travel agencies, and engineering firms. And it's through this partnership that we actually get the unique opportunity to support businesses. So as Heather advances the slide here, I'll allow her to dig a little bit deeper into the partnership that she has with BMO and what we're doing for clients today via this learning opportunity.
Awesome. Thank you, Ron. Adam, maybe you can pull up the materials and we can start to talk about this opportunity we have in partnership with BMO and also this platform through NASDAQ. So thanks to BMO and their sponsorship, we are offering today 5 winners of the ability to have a fractional CFO. Yours truly, Adam Baker, who's on the line, you'll hear from shortly. And this is a $1,500 value. I can't express how significant this value is. You get your financial forecast built for your business. In addition to that, we will have monthly updates with you on your progress. I'll say what's not included on this slide too. We do a business health assessment for you. It is a non-invasive health assessment. It doesn't ask you, the details of your home life and your personal finances or anything. It really is a general overview of areas of strength and weakness around your business. We give you those results. They come with an action plan. And we also provide you some insights into ways you can improve your business, whether that is on the revenue side of your business, the expense side of your business, or just monitoring the ratio between your profit margin of your business over time. We're going to dive into that a little bit more today, but let me turn it over to Adam Baker. Adam has been a CFO for Arena for over a year now, I believe, and serves a number of different clients, all different types of segments, and is able to really dive into your business and provide you with insights on a very low touch. It really doesn't take much interaction with Adam for him to understand how your business is working and ways that you can improve your business over time. He does a lot behind the scenes before he even interacts with his clients. So I applaud him all the time for his efficiency. And I think that is the thing of most value to a lot of businesses out there. So don't miss out. Just registering today for this webinar enters you to win this actual benefit that BMO has sponsored. So if you are one of the random selected participants in today's call, you will be getting an email in the next probably 24 to 48 hours at most, telling you that you have won this service. And then from there, Adam will pick up with you and basically build out a number of financial needs for your business that every business needs. So with that, let me turn it over to Adam.
Thanks, Heather. Yeah, that's a great segue. And I've actually done over 15 of these already with the sweepstakes winners. And I get so much value just myself out of this, being able to partner with, small business owners. I always learn something. And it's amazing the value they get, whether you have a robust forecast or not, just really trying to share my insights, the insights from Arena, BMO partners, just adding everybody in there. It's amazing value. And folks always come out the other end with great things to say. So urge you to take advantage of that if you're one of the lucky winners. But now we'll jump into our presentation here. So really the first part will be centered around key performance metrics, and then we'll quickly flip into some of our question and answer sessions where, a lot of the value kind of comes from too. So I want to start off with what is a key performance metric. You may have heard KPI or OKRs here. And it's a quantifiable measure of performance over time for a specific objective. And I read that slide very slowly and intentionally. So quantifiable means, hey, we can calculate this. And at least in the back of my head, we can calculate this quickly, efficiently, and accurately. It's not some crazy, long, complicated formula to get to. We can get them very easily. And these are a measure of performance. So the whole idea is great. We've got this cool number. It looks great. What does it mean? Are we doing well? Are we doing poorly? Are we improving? What can we do? So really it's meant to drive action behind this. So if you're not using it to drive action, there's no real point in tracking. One additional point is the over time piece. Great, we've got our number, one moment in time, that's wonderful, but are we improving? Are we declining? What are those areas of opportunity? So it's great to track these on a steady cadence, and whether it's daily, weekly, monthly, we'll get into that in a little bit, but really keeping track of that over time tells us how we're performing. And then specific objectives. So we want to make sure that we're very focused on what we're looking at. So this could be for the whole business, for a business unit, for a particular product, for one service that we offer. So we want to be as specific as we can to make sure we're driving the right action with this. So I want to touch on really 4 metrics here. There are quite a few out there. You can do a quick Google search of best key performance metrics and you get a whole list of them. But these are the top 4 that we really want to recommend taking a look at today. One is net profit margin. The next is customer acquisition costs. You may have heard CAC before. The third is cash conversion cycle, or CCC. And then I threw in a couple of key banking ratios, which are critical importance when you're working with a fine lender like BMO to really understand some of your financials from that lens too. So we'll dive into each one of these in a little bit more detail. First up is our profit margin, or net profit margin. And this is critical for any business across the board, right? We want to be able to tell how we're performing as a business. And this really measures how much profit we're generating on a set amount of revenue or income. So our profit is our revenue minus any of our expenses. So that's everything from cost of goods sold, our interest income, payroll, lawyer fees, all the way down to that bottom line is our net profit. And these are, critical numbers to take a look at to really tell us how we're operating our business. And the ratio is important because we could have growing revenue, which is awesome, right? Everybody loves to have more revenue. But if our expenses are growing faster than our revenue is, this ratio is actually going down over time. So we really want to make sure we're increasing our revenue at least in line with expenses, preferably more, to really drive this ratio up. And I'd really, again, looking over time, investors want to see a track record of a growth in this number. So our margins are expanding. We're making more money versus our expenses here. And what is a great profit margin? Really, we want to see that at least 5%, and that's a positive 5%, and holding steady or growing there. If you're under that 5%, you're, might want to reconsider some of your cost side or expand your revenue stream. So that could be increased pricing, which we'll get into a little bit more later. Offer additional products or services while keeping those costs under control. So very critical there. Keep that in mind. In general, the 10% net profit margin is a great number to shoot for. 15 better, even higher would be amazing. So really want to keep track of that. I definitely recommend taking a look at this on a monthly basis at a minimum. So, hey, we've got our books closed for the month. How are we looking for our net profit? And really another one I love to do is a rolling 3-month average or a rolling 12-month average to really see, taking into account, we might have a great month or an off month, but really taking that average into account to see. The next one here is customer acquisition costs, or CAC. And this is really knowing how much it costs to bring on a client. And there's a very simple formula. So customer acquisition cost, or CAC, is our cost of sales plus our cost of marketing, all divided by the new customers acquired. And there's a lot of back and forth on, hey, what's included in cost of sales, right? I like to include everything that would be sales related. So in this case, I would include our sales salaries, our commissions, and then any tools or software that we use to facilitate sales. So, hey, you might use HubSpot to generate your quotes, keep track of your leads, et cetera. I would include that cost in here. Similar for the marketing side. So this is all the salaries and commissions or anything involved with marketing, as well as any ad spend. Hey, we launched Google Ads, $500 a month on this. That would all be including in that marketing cost. And then this is simply divided by the new customers acquired. Again, generally this one would be, a monthly base metric. Hey, we've got all of our expenses, our cost of sales and cost of marketing, and then how many new customers did we acquire in this period. And this number is great, but I think it's really valuable when we tie it together with another metric, not listed here, but it's LTV, or lifetime value of that customer. And that metric is how much revenue, how much value are we extracting for each customer. So this is a great metric to say, hey, we're bringing on a customer, I would throw out some numbers, for $1,000, but we're only able to extract $1,000 out of that customer from the value side. So it's not really worth it there. A good ratio between those is a 3-to-1 or 4-to-1 ratio. So that would be, hey, we're extracting 3 or 4 times as much value from that client customer versus what we spend to acquire them. And I've got a couple of averages, and of course this is different, industry, very focused, differences between your businesses, but just a couple of averages. In the SaaS industry, this is roughly $700 to acquire a new customer. B2B businesses could be $500. And then some of our e-commerce businesses can be much lower, in that $70 range. And those are just, ballpark metrics to kind of keep in mind there. Of course, if each client for you is generating $1 million a year in revenue, we might be willing to spend a little bit more than $500, to acquire those. So those are all, very specific. And just want to throw out a couple ideas for actually improving your CAC. A lot comes back to the data side, to really analyzing our performance for our marketing channels and optimizing which ones give us the best returns. Let's select our ads and really focus our ads on the clients we're looking for, for example. Another is optimizing our conversion funnel. So, hey, we're collecting, this broad group of clients, contacts. We really want to optimize how quickly we're converting those and increasing those conversion rates. And you can do that from identifying the right folks you want to get at the top of the funnel, and then reducing any friction to sign up for your service, to buy your product. Make that as easy as possible to bring those customers on board. Another one is really segmenting those customers using that data. So great, now we can focus on a particular subset with our ads to bring that in. And one last one is offering some personalized onboarding experiences to really extract that longer term value. It might take a little bit more time and effort up front, but if we can keep that client on board for quite a while, that'll really start to pay back. And then finally, one of my favorite ones is offering some referral type programs to your current clients. Hey, I'm going to give you $100 or 10% off your next bill to promote my product, or to, give me a referral. And generally that's a great word of mouth advertising. If you can get a recommendation from someone you know and trust, that says above and beyond the value that you receive. So we'll move to the next one here. This is the cash conversion cycle. And one of my favorite quotes is, revenue is vanity, but cash is king. All of you know from operating your business, hey, it's great to earn more revenue, but we can't spend revenue. We're ultimately spending that cash, and we need that cash to be able to pay our bills, to make payroll, to reinvest in the company. So this CCC, or cash conversion cycle, is really knowing and understanding the time between the money out the door and the money coming in. So this is really cash flow related. And the simple formula here is days in inventory. So that's our resources we put in inventory, how long they're staying there, plus our days in sales. So this is days in accounts receivable,
basically how long does it take us to get paid, and then subtracting out our days of payable. So how quickly are we, paying our vendors, our suppliers from that standpoint. And really for this one is the lower the better. So we can even get this metric down to a negative number. So that means we're bringing in more money than we're actually spending to fund those resources. So this is traditionally around a inventory-based business. So, hey, we've got a physical product. We're investing in that cost of goods sold to produce those widgets. But you can actually replace that inventory cost with a headcount cost, for example, if you're a services firm, to really help get this metric, in line for you. And some of the ways to reduce this CCC, again, measured in days generally, is to reduce that time. So, hey, can we get our clients to sign up earlier? Can we deploy our individual teams from a, services-based business faster? Can we collect earlier? Maybe we could offer an incentive, hey, 1% off, 2% off to lower that AR or net payables time. We can start charging them in advance. So, hey, I want to collect that money on day one for a 30-day service. And additionally, hey, maybe we have a longer project, a lot bigger dollars. Collecting a down payment or a small portion of that upfront really helps bring that cash in the door to ultimately fund our operations a lot faster. One of my favorite ones is, and Heather lent me this idea, was the Starbucks gift cards. You think, hey, you go to Starbucks and you buy a gift card for your friend. Starbucks has that money already in the house. So they've got that money. They can use that to fund their operations. So that's just a great example of collecting that cash earlier. And then some folks may or may not even use that card. So that's just a great, quick tip there for a business. Hey, maybe offering one of those gift cards or something like that to help bring in that cash earlier. The cash is king. Next up, we'll talk about some key ratios here, and these are focused around our banking partners. So the first one is debt to income ratio, and this one is total monthly debt. So thinking, hey, I need to pay out $1,000 in interest and principal payments over my gross monthly income. So that's how many dollars I'm bringing in a month. This is one that our friends at BMO like to take a look at if you're looking to get a loan here. Lower is generally healthier. So that means we have lower debt versus our monthly income. You generally see the rough guidance of 35, 36% here and below. Means you're in a pretty good shape from a debt to income ratio. Some quick ways to fix this one are raise the income or lower the debt. Those are generally quick ways to boost this ratio or get it a little bit lower. The next one, moving over to the right, is the quick ratio. So this one is cash plus accounts receivable, which are also known as current assets. So, hey, these are funds that we have today or could readily have available, all divided by our current liabilities. And this is basically a measure of how liquid you are. So how quickly can we get cash or use our cash to cover any liabilities, so, pay off our quick debts there. A normal ratio here is about 1-to-1. Generally lower is bad. If you're falling below that number, we might want to have a discussion. Happy to chat from the strategic side on how can we really boost that cash and accounts receivable and lower those. Moving to the lower left, we have our debt to equity ratio. This is total liabilities. So all of our debts, everything we owe, divided by our equity. And some general rules of thumb here, this is very industry specific, but could be 0.2 up to 1.2, this ratio here. And it really evaluates your financial leverage. So are you financing your operations with debt, the liability side, or using your own resources? And this one's actually kind of tricky. We have that range of 0.2 to 1.2, because higher is a little bit riskier. That means you have more liabilities, more funds that you ultimately owe back to the bank, to someone else, right? So those liabilities go up. But we don't want to see this too low. You don't want this down to be 0, because that means we're not taking advantage of debt to expand. So we could be bringing on a little bit more debt, using those resources to ultimately fund the growth of our company to really ramp that up or spend a little bit more. I know a lot of small businesses are often hesitant to bring on debt, and it's totally understandable. But just keep in mind that we could use that debt very strategically to grow the business. And the final one in the bottom right here is our EBITDA margin. And some of you may or may not be familiar with EBITDA. That's one of our favorite acronyms here, but it's earnings before interest, taxes, depreciation, and amortization. And I'll say that again, it's earnings. So the money we're making before interest, taxes, depreciation, and amortization. And basically this number is saying how profitable your business is through operations only. So that earnings before all those other pieces. So how are we really performing from an operations side before we pay our interest payments, before we pay taxes? Yes, we all have to pay taxes before depreciation or amortization comes out, all divided by our total revenue to really get us an EBITDA margin. And this one's critical when you're generally looking to sell your business. I'd recommend, keeping an eye on this on a monthly, quarterly basis, really making sure this stays healthy. Investors, potential buyers really look at this number to say, how profitable are we through operations? Because some of those other things, we can take care of from a portfolio perspective. But we want to make sure our operations are profitable. And best numbers here are all across the board, really depends on your type of business. So that wraps up the key metrics there that I want to hit on. And I did just want to offer some, pro tips here to really help provide more intel on our metrics. And again, these metrics are meant to be action oriented and really drive the behaviors of our team. So if they're not doing that, we might want to take a look at that. And we can consider offering these. Hey, if all these are sales focused, all of our metrics, everything that we do will be sales focused. If they're operational, we'll be generally thinking about operations quite a bit more. So it's important to balance all these. And some of the tips are automate. The more we can automate these, make them easy. Could be as simple as a copy and paste of your P&L into Excel with some formulas in there. Could really help with that. You can even get more advanced, automating those if the calculations are a little bit more complex. But the easier, the better. Again, similar to customers, the more we can lower that friction, the easier it is to take a look at. Generally, for most of these, recommend a monthly review. We'll get into one of the questions actually here a little bit later, but some might want to look at daily. We might want to look at weekly. We could push out to a yearly review, but most of the ones we're looking at are P&L focused, profit and loss, or income statement focused. So we want to be able to take a look at those monthly, even if we're just taking a peek to understand the focus. And down the bottom left, the visualization side, I'm a big proponent of charts and graphs, images, visuals. It really helps, especially for a busy entrepreneur, right? You've got 21 different things that you're trying to take a look at to handle today. How can you see these numbers versus some guardrails, versus last year, versus our budget, right? Very quickly and easily using some visualizations to really help you pinpoint out where are the problem areas. Great, let's go focus there and direct the team. Yeah. So really recommend those visualizations. Doesn't have to be anything crazy. Could be a simple, bar graph or line. And then finally, involving the team, as much as you can, as much as you're willing and able to share the books there with the team. Maybe it's a leadership team, but really bringing those folks together to understand what are the key performance metrics for our business. Which metrics drive value, which metrics drive action, which metrics drive this positive behavior, and allowing them to really understand what those are, but more importantly, what goes into those and what they can do to change them. So, okay, how can I, as a salesperson, drive more revenue to boost this ratio? And what does that mean for the business? Why would I care, about doing that, especially as an individual employee? So highly, highly recommend involving the team as much as you can to really get that buy-in from them and drive those positive actions. So now I'll turn it over back to Heather to pop on and really talk about some of the offerings that Arena has and how we can help both on the business metric side and outside.
Great. Thanks, Adam. Great presentation. And all of those metrics are so important to running any business, no matter how small you are, how medium you are, how long you've been in business. Putting them in place early on is critically important. So I'll just remind everyone, please take advantage of the Q&A portion of the webinar. It's down at the bottom of your screen. Feel free to load it up with questions as I'm kind of talking through how Arena can help support your business. And then after that, I'll turn it back over to Adam to start to answer some. We also have some pre-registration questions that have already come in. So we kind of have a format to some of the questions that we've gotten already. Anything from operational to expense management to revenue based, any of those types of questions you might have. Adam will be, his wheels will be churning as I'm kind of describing these additional Arena services that we have to offer, and then I'll turn it back over to him. So Arena offers fractional support for businesses for any pieces of your finance function. While the award today, if you're randomly selected, the one of 5 businesses that are here today that are going to receive free CFO services for 3 months, that is going to include your financial forecast with some key metrics, as well as your business financial health assessment that will come along with that. You will be paired up with Adam, so that will be awesome. But Arena also offers a broader swath of services for your finances of your business. We help with other types of planning and analysis. We do some long-term forecasting. We also will help you with specific business metrics for your industry that are beyond the ones we've talked about today. We help you with capital investment planning. We actually help businesses apply for loans, prepare for venture capital raises, and really understand the burn rate for their company and the cash flow management that they need to have at their fingertips to manage their business. We also do advisory services if you're considering an acquisition, expansion to another market, another industry, a different product line. Also, how to exit your business. At some point in time, you're going to want to exit your business. And knowing what that is earlier in your entrepreneurship journey, the better it is. And we can also support that. We help you with any kind of loan document preparation you might need. We do vendor contract reviews. We've seen a number of businesses that have come to us after they've signed vendor contracts that they didn't quite know what they were getting into, and it's gotten them in trouble with long terms and escalating, fees, et cetera. We have a couple of people on the team that will dedicate some time to reviewing contracts prior to your signature or any renewals that you may have. We also do like business plan preparation as well. We'll do some competitive landscape analysis. We help you prepare pitch decks in a lot of ways and understand what the market is out there that you're entering into. And we do foundational accounting as well. We'll do accounting from your month-over-month expenses versus your forecast. We'll do that delta, and you can basically see what the difference is and where you predicted it right and where you didn't and where you might want to make some changes. We also do kind of forensic accounting. We do accounts receivable. We'll help you collect against all of the outstanding invoices that you may have. We'll help you issue invoices. We also come with recommendations on how to reduce that cash conversion cycle and receive money from your clients earlier. We also help with accounts payable. We can take on that entire function for you. That includes payroll, as well as we will also make recommendations for you on a number of different payment platforms, whether that be employee benefit platforms that it might be time for your business to consider, et cetera. We do bank reconciliations. We do everything up until it's time to file your taxes. We do not do tax preparation and filing, but we will prepare everything for a very easy handoff to your tax accountant. With that, we are open to working for as little as 2 hours a month. So we operate in a very fractional way, which is very affordable versus hiring a CFO or finance professional full-time. And that is our niche. And that's why we built the company, is because we realized that there are 33 million businesses in the United States. There are only 200,000 CFOs. And with that, they don't have the financial support at their fingertips, nor could they possibly afford it as they were getting started. So that's what created the company. We offer CFO services and accounting services in a fractional way for your business. All we do is a very quick evaluation to get started, and then we'll put together a quote for your consideration, and would always appreciate your business. With that, let me turn it over back to Adam to start to get at some of the questions in the Q&A. We might start with some of the prepared ones as we get organized through the Q&A window.
And then just to touch on, as one of the CFOs partnering with the small businesses, those 2 hours can go a long way, to just provide some quick insights, some strategic direction to really let the entrepreneur or the business owner to go off to the races. So sometimes that 2 hours, 2 hours a month becomes invaluable to some of those.
All right, we'll jump into the questions here. We collected some of the questions beforehand, so thank you very much for providing those questions up front. We bucketed them into these kind of 4 main buckets. So some internal costs, operations, pricing, and then even some metrics ones, very focused on the conversation today. So I'll run through very quickly some of the prepared ones. And then Michelle, if you could help facilitate, some of our additional questions coming in through the Q&A, that would be amazing.
Yeah.
Wonderful. So starting off with internal costs, this is a great one. Which costs should I focus on to increase profitability? So reducing costs, right? Some of my favorites are getting rid of those subscriptions or fees that we don't use, right? Hey, I've got my gym membership and I never go to the gym, right? Similar things for business, right? There's software membership services that you really just don't use. So take a quick look at those. Generally, quarterly is a great time to look at those. Reducing those low ROI spends. This is one of my pet peeves, right? We've got this new system. It's going to be great. We adopt it. We bring it on board. We start paying for it, but we don't have an owner and then no one's using it. So we're really getting low ROI for that. And then the next couple are wages and benefits or cost of goods sold. This would be how do we utilize our resources more efficiently, right? One of my favorite metrics is the direct labor efficiency ratio. So how many dollars for a service-based business is each employee generating? So how can we enable them? I love the tech-enabled worker to really be able to provide more value with some tools in place to really get more revenue per person. And then cost of goods sold, always recommend, hey, how can we find cheaper, easier ways to produce that product, that widget, without sacrificing quality, of course, and quality being. And then how do I calculate ROI? This is easy and then hard all at the same time, right? So that ROI piece of that return on investment, it's an approximate measure of the investment's profitability. And it's really the return, the benefit that we're getting divided by the cost of the investment. And I say it's easy because these formulas are simple, right? The final value of the investment minus the initial value over the cost is very easy to do mathematically, but often difficult depending on the type of, item that we pull in here. So highly recommend take some time to really understand what that value or the return would look like there divided by that cost. And we can definitely help with that piece too if you really want to dive into one of those. The next one is focused around pricing. This is actually one of my bread and butters or favorite things to do is focus on pricing. You'd be amazed at how many big businesses grow and grow and grow, very successful with no idea on how to price their products or services. Hey, what's the competitor doing? Great, let's match that, right? But a lot can go into this. So one of the questions is, how do I raise prices without losing customers? And I say pricing is both an art and a science. There's a lot of analysis, a lot of psychology that really goes into this, but a lot of it is an art too. There's very skilled folks out there building pricing appropriately, and pricing and packaging of how do we, put those products, put those features together in the right way. And back to the data, how do you raise the prices? You really got to understand the data behind that. So that's surveys of your customers, internal, do some A&B testing, right? Maybe launch your product at $5 and have a similar base product at $7 and really see how we're doing there. And then churn can be a great indicator from the data side too. Great, we bumped up our prices. Now we're seeing 50% of our customers churn over time. So that might be one. Hey, dial that back a little bit. We're getting that real feedback from the client of this price is not working. Really pricing to value. So instead of, hey, what does this cost me plus 10%? How can we price to what the customer actually values? Whether it's pricing levels, again, back to the packaging, fulfilling those customer needs. That's where that customer insight, get on the phone with one of your customers, several of your customers, and interview them. What do they value? How much would they be willing to pay for that? And then definitely recommend incremental increases at a regular cadence. So this is not every week we're going to push through a price increase, right? And not doubling price every month, but having a set cadence, hey, maybe once a year, or revisiting our prices and bumping those up. And the last piece I just want to touch on is clear communication. I think we've all been subject to receiving a price increase without being notified. So just provide that clear communication of here's the price increase, raising prices by 10%, to keep up with market inflation. And generally that's all you need to do. And folks are very appreciative of understanding where those price increases are. The next question, are there specific pricing training plans out there? I love this question. And yes, Arena offers this service. And then again, this is one of my favorites, and actually wrote a blog article there linked. The pricing is right, just touching base on some of those, and would love to partner with you on developing those pricing plans. A lot can go into that to really develop that versus, the thumb in the wind type initiative. And then HubSpot, Udemy, and other great articles and resources are out there to really cover the basics of that. You can spend an hour taking a look at these resources and get a pretty good understanding of how to do the basics on price. Next category was operations. So this is a great question of how do I make sure that I get paid? At the end of the day, that cash is king. We got to get paid, right? So really one is controlling the payment, set up those automatic payment plans, get their credit card, ACH information, and build those in automatically. Coming back to the down payment or deposit, charge in advance, get those funds up front, and then retainer fees, kind of that monthly recurring. And then are there any tools, templates for forecasting? Yes, this is one of Arena's great product services we offer. And we actually have 2 forecast tools at the link here for tools and templates for forecasting, kind of a simpler one and a more advanced one. And then really main recommendation here, stick with what you can do regularly. So if you're not going to be able to keep up with it, find someone who can, or keep it simple and really keep that use regular. And then how about business plans? Yep, Arena offers that business plan development like Heather talked about. So we offer some great tools and resources around that. And then the SBA, great resource for just some simple business plan templates out there, the link provided too. Final one here before we open it up, metrics. How many metrics should I have? That's a great question. My general rule of thumb is 3 to 10. You want to have a couple that drive action, but you don't want to have too many. I would probably even say 7 kind of being the max there. We want to keep these easy to update. We want to make sure they're driving value and we can put the time and focus in those. We want to make sure they're having an impact and driving decisions. And how frequently should I monitor? I kind of mentioned this throughout, but some we might want to look at daily. Hey, how are our sales doing? Do we have any customer service issues today? How is that trending? We'll be looking at weekly, so maybe our cash balances. Make sure we have cash in the bank to make payroll, right? APAR included in that. Monthly, just any of our financial statements, making sure we're looking at those, and could revisit CAC then as well. Quarterly, taking a look at our bank metrics we talked about, DTI, et cetera. And then yearly recommend, once you get to a certain point, if you're interested in that exit, keep an eye on your company valuation. And at that, Michelle, if you could help facilitate from the Q&A here, I'd appreciate it. And Heather, feel free to jump in, as well, if you got some great answers to this.
Awesome, Adam. Thank you so much for such an incredible presentation. Shared a lot of awesome insights and really got at a lot of those, most common questions that we were seeing with the audience. And Heather, thank you for sharing all the resources. Definitely check those out if you're in the audience. We'll continue to share those links in the chat and following the event. And yeah, let's jump right into Q&A. So I guess just to start off, we have a lot of different kinds of questions here, that are asking, specifically about the business, but without giving too much detail about the business. And I think it's really getting at kind of like how, looking at these metrics that we've talked about just now, especially early on, with limited, data or business history. I think there is, like a disconnect in terms of how those metrics like directly translate into like strategic decision making, whether it, has to do with customer acquisition or engagement or decisions around, product service development or scaling and partnerships, like, could you maybe like share some examples of, like how, these metrics might actually translate into, certain strategic decisions?
Of course, yeah. I think one that really comes to mind for me is the CAC piece. So customer acquisition cost of sales and marketing over new customers. And that one's critical for our SaaS business, so service, software as a service, any service business from that piece. And I think when I look at that, I'm seeing how effective my sales and marketing team is. So that might be strategically, I want to spend more to acquire more clients. So maybe I bring on another salesperson. Maybe I boost my ad spend to really start to acquire those clients. And this is one that you really want to keep an eye on over time. Great. We've increased that sales. We've brought on a new salesperson. We're boosting our ads. We're doing more ads, but we're not getting any more clients. So that might be a revisit of this CAC metric. It's going down. We're not getting more customers. What do we need to do tactically? Maybe that salesperson isn't effective. Maybe our ads are not targeted or focused right. Maybe we're not looking at the right people there. So those are just some, ideas that come to mind specifically around CAC. And I think it's really as a new business owner, you don't have time to look at all those metrics and maybe think about that. So that's really where I think of those like 2 hours Heather mentioned of with a CFO is like, how do I look at these metrics? Give me some insights, give me some knowledge around that we could really like partner with and be able to provide that strategic and tactical focus.
Mm-hmm. Yeah. Oh yeah, go
I'd
ahead.
also add another one to that, which would be like profit margin as an example. There are some industry standards on what your profit margin should be for your given industry. They're fairly easy to find. There might be some esoteric businesses out there that you just have to create a baseline for yourself and create your own threshold. But in general, like the red flags should go up, and you need to make strategic changes to your business when your profit margin is below 5%. So that means that you need to think about ways of changing your revenue that's coming in the door. It could be a pricing change. It could be an increase in sales. And then you also need to consider things that can impact your expense side as well. So profit margin is another one that can be a great strategic driver for conversation, in that if it's below 5%, then you should definitely take action. And if it's not, that might be something that, hey, something's going right here, and let's just keep on going.
Mm-hmm.
I was partnering with a services business recently, and they set a budget, right? Sales target about 500,000 and set their expenses appropriately, which was great to maintain that 5-10% margin. But month over month, they were not hitting that sales target, but kept the expenses the same. Great, let's keep all the expenses, facilitate that 500,000, but we're only hitting 300,000. So that would be like, to Heather's point, the red flags are going off. Month over month, we're seeing that trend go down. So that would be another example of, hey, let's make some decisions.
Right. Yeah. I love this idea of like kind of, thinking about, these metrics as almost like signals kind of sounding off and prompting you to, make certain strategic decisions and look at, reevaluate certain areas of your business. And I think that just reemphasizes something you mentioned earlier in your presentation about, reevaluating these numbers on like a monthly basis at least. And, really just, making sure that you, invest that time to, be aware of these numbers that could really impact, for the better, the strategic decisions you make for your business. So, thank you. That's awesome. We had a couple questions, specifically about, financial management and, leveraging the expertise of CFOs. So Heather, can you maybe talk a little bit more about just in more depth the benefits of bringing on a CFO, and how founders can really best support that role when they implement that into their business?
Yeah, I'll speak to a couple things here. So first off, when you hire a fractional CFO, you need to treat them like they're a member of your team. It's important that you if you share the details, good, bad, and ugly, with your fractional CFO. It is often the situation where we'll bring a client on and their personal expenses are commingled with their business expenses. Don't be ashamed of that. Lots of businesses do that. The worst thing you can do is hire a CFO, whether it's fractional or full-time, and hide the information from them, because they can't then make the right recommendations for you. So I would say you're wasting your money unless you're willing to be open and transparent with your fractional CFO or full-time CFO or finance team in general. The second thing is, as you're evaluating a fractional CFO or a full-time CFO, make sure that they have some type of experience in your industry or a very near industry nearby. If you're a service-based industry, then I would recommend that you hire a CFO that has some type of service-based experience. They will be used to the levers that are the most advantageous to pull for a company like that on the revenue and an expense side. They'll also have more benchmarks to share with you from your competitor set. And that is another beauty of a fractional CFO. Oftentimes you're getting a fractional CFO that has other companies just like yours in other areas that serve different markets or the same market. And you get insights into that you wouldn't otherwise get. So that's another a thing to look out for. I would ask about the resume of the CFO that is be either interviewing for the job or presenting a proposal to you in a fractional way. So those are a couple of things. I don't feel like geography is important unless you need it as a business leader. So that is something that opens up the territory after COVID, and we've all gone virtual and everything. It has really made it really easy to find expert CFOs and finance professionals that know a business like yours. So I would make sure that you're open-minded to that. The balancing act there is if you do have a virtual fractional CFO, that you include them in the important meetings, your annual strategy sessions, if you have those, your powwow when something goes wrong at the company and you want to like problem solve fixing it. Include them in those things so that they understand what your pain points are and can also help drive some decision making with you. The other beauty of it is it creates this financial discipline around your business that a lot of business owners don't have. I always share the statistic. I think I did it last time we got together with you guys at NASDAQ, is 90% of businesses out there in the United States, of the 33 million businesses out there, do not have a financial forecast. They don't have a plan. And that's when they've been asked simple questions like, how much money do you want to make this year? And how much do you think it's going to cost you to make it? Those things are just critical to answer. And it's one of the reasons why that 50% of businesses fail by their 5th year. So I just always recommend as you're evaluating a CFO that they have the experience in your industry and that you don't shy away from it. Try it out. There are a lot of fractional firms out there that are my competitors, and that you can actually try out for a 3-month period. They will do a 3-month proposal for you. And they can actually get you set up if you feel like that you can then take the reins from there. They can get you set up. It's more expensive to do it that way. But oftentimes business owners like to dip their toe in the water before they jump in.
Love it. Absolutely. Adam, anything you wanted to add there?
Yeah, I love to add one of my favorite clients working with, she was saying that you're kind of like my financial therapist, as a CFO. Like Heather said, I'm sharing the good, the bad, and the ugly, right? So working through those details. And like Heather said, being a part of that, whether it's personal, business, I like building those relationships, being part of those team meetings or strategic sessions. Like that's where the value comes in. I understand you, I understand your business, and we can build that relationship to really drive the business forward and provide some good advice.
Love that. Yeah, love this idea of, really thinking, just like any other employee or partner you bring on, really making sure that you're aligned in those key areas. So thank you. That's awesome. I think we have time for one more question before we close out. And I wanted to ask, we have, a couple entrepreneurs, at the beginning of their business journey, really with limited, business history, curious about, first steps, how they might get started on, really setting a good foundation for long-term, forecasting and financial planning. And I also, if we had time, would love to, touch on as well, what that can look like for a business that's looking to pivot, and how, just best practices around, managing finances, during those transitional periods.
Yeah, I'll take that one. And my first initial thought is start today. You might be doing it wrong. You might not be doing everything right, but start collecting that data, start building the rigor around that. Take a look at your financials,
call up your accountant, your bookkeeper, your best friend. Hey, let's look at our financials just for an hour. Just put in that rigor and practice, really build that muscle around that and get comfortable with them. Finances can be scary, but they're not, I promise. And that's kind of where we come into is like, great, let's take a look together. We'll hold your hand along the way. And I'm big behind that educational piece. I would love for every business owner to understand the basics behind their financials. Like that allows them to have the knowledge to make those decisions all by themselves. Love to be a part of that, but they can really take the lead from that standpoint.
Totally. Heather, do you want to add anything?
Yeah, I agree. Get started. And get started with measuring. And do so in a simple fashion. Pick two things you want to achieve, and make sure you're just because you like the metric of CAC, make sure it means something to your business, and make sure that it's driving action. If a metric is not driving action, question yourself as to why you're spending time on it. If that's where you're spending too much time, and you might want to replace that with something else. The other thing is, I'll share what I did when I first started Arena. Is I set up a monthly business review with myself because I was the only one here. And I just was determined. I blocked off an hour. It was a meeting I set with myself that just reviewed how I did over the last month. And there was a lot of, oh my gosh, moments in that, because it was my time to reflect. And it allowed me to just take a step back, zoom out of my business and look in. And it was truly beneficial.
Awesome. Well, Adam, Heather, it has been such a pleasure on behalf of the NASDAQ Entrepreneurial Center and everyone here today. We are just so thankful that you joined us. And I guess, Adam, we'll start with you. If you had just one key takeaway that you wanted to leave with the audience or piece of wisdom, what would that be?
I want to go back to the start now. Finances are not scary. Start now, like Heather said, measure something, take that hour, slow down, make sure you understand your finances. And we're always here to help too if you ever need a helping hand along.
Awesome. And
Yeah.
Heather?
Mine would be, you can all do this. Everybody has it in them. This is a place where entrepreneurs thrive. That's one reason why people come to the US to begin with. And I think Canada is close behind it for those that are in those two locations, but you can do it. There are resources out there to help you. And when you're stuck, seek out support, whatever it may be, whether it's finance, HR, whatever it may be.
Awesome. Heather, Adam, thank you both so much for joining us today. Always a pleasure.
So our pleasure as well.
Awesome. And to our audience, we would love for you all to join us again for upcoming webinars, which you can view using those links that are going to be posted in the chat. And thank you so much for joining us today. We look forward to welcoming you back online with us soon.